Lesson: Decision Modeling. Decision modeling is a cornerstone of effective business analysis, providing a structured approach to tackling complex decisions that organizations face. By utilizing decision modeling, business analysts can break down decision-making processes into manageable components that facilitate clarity and improve outcomes. One of the most prominent frameworks in decision modeling is the decision tree, which aids in visualizing decision paths and potential outcomes. Decision trees offer a graphical representation of decisions and their possible consequences, helping analysts weigh the risks and benefits associated with each option. For instance, consider a company deciding whether to expand its product line. A decision tree can illustrate potential sales increases against the costs and risks associated with new product development, enabling stakeholders to evaluate the merits of different scenarios. Another significant tool in decision modeling is the use of decision tables. These tables provide a concise way to represent complex business rules and their associated actions in a tabular form, which is highly beneficial when dealing with numerous variables and conditions. For example, a financial institution might use a decision table to determine loan eligibility based on variables such as credit score, income level, and existing debt. By systematically organizing information in a decision table, analysts can ensure consistency in decision-making and streamline the evaluation process. Decision modeling also makes use of simulation models, which allow analysts to assess the impact of various decisions under different conditions. Monte Carlo simulations, in particular, are widely used to understand the implications of uncertainty in decision-making. By running a multitude of scenarios with variable inputs, analysts can predict a range of possible outcomes and their probabilities. A practical application of this could be seen in inventory management, where a company uses Monte Carlo simulations to forecast demand fluctuations and their impact on stock levels. This helps the company to optimize inventory costs while minimizing the risk of stockouts. Incorporating statistical decision theory into decision modeling provides a quantitative basis for selecting the best course of action. This approach involves defining decision problems in terms of probabilities and utilities, thus facilitating more informed and objective decisions. For instance, a pharmaceutical company might apply statistical decision theory to choose between investing in multiple research projects with varying probabilities of success and potential payoffs. By analyzing expected values and utilities, the company can allocate resources to projects with the highest expected returns. A case study illustrating the efficacy of decision modeling can be seen in the logistics sector, where companies face decisions about route optimization and delivery scheduling. By employing decision modeling techniques, a logistics firm was able to analyze various routing options, considering factors such as fuel costs, traffic patterns, and delivery times. The use of a decision model enabled the firm to reduce transportation costs by 15% while improving delivery efficiency, demonstrating the substantial impact of structured decision-making frameworks. In practice, decision modeling often involves integrating multiple tools and frameworks to address complex, real-world challenges. For instance, a manufacturing company might combine decision trees and simulation models to decide on the adoption of new technology in their production process. The decision tree could outline the strategic choices and their immediate consequences, while the simulation model would provide insights into long-term effects and potential risks. By leveraging both tools, the company can make a well-rounded decision that aligns with their strategic objectives. The use of decision modeling is not without challenges. Analysts must ensure that the models are based on accurate and relevant data to avoid misleading conclusions. Additionally, the complexity of decision models can sometimes lead to overfitting, where the model is tailored too closely to historical data and fails to generalize to new situations. To mitigate these risks, it is crucial for analysts to validate their models with real-world data and continuously update them as new information becomes available. Moreover, effective communication of decision models to stakeholders is essential for their successful implementation. Business analysts must be adept at translating complex models into actionable insights that can be easily understood by decision makers. This often involves the use of visualization tools and techniques to present data in an intuitive manner, ensuring that stakeholders are equipped with the necessary information to make informed decisions. Decision modeling also plays a critical role in risk management, allowing organizations to anticipate potential pitfalls and develop contingency plans. By identifying and analyzing risks associated with different decision paths, companies can proactively address challenges and minimize adverse impacts. For example, in the context of project management, decision models can help project managers evaluate the likelihood and impact of potential delays or cost overruns, enabling them to implement strategies to mitigate these risks. The field of decision modeling continues to evolve, with advancements in technology offering new opportunities for enhancing decision-making processes. The integration of artificial intelligence and machine learning into decision models is a burgeoning area that holds promise for improving predictive accuracy and providing more sophisticated insights. Machine learning algorithms can analyze vast amounts of data to identify patterns and trends that may not be immediately apparent to human analysts, thereby enhancing the decision-making process. In conclusion, decision modeling is an invaluable technique within the realm of business analysis, providing a structured framework for evaluating complex decisions. By utilizing tools such as decision trees, decision tables, simulation models, and statistical decision theory, business analysts can enhance their decision-making capabilities and drive organizational success. The practical applications of decision modeling are vast, with its principles being applicable across various industries and decision contexts. As the field continues to advance, staying abreast of new developments and methodologies will be crucial for business analysts looking to maintain a competitive edge in their decision-making processes.